So I'm Robert Barton. I'm the Senior Director of Oil Products for Genscape. I'll be conducting part of the webinar today along with my colleagues, Colin Halling, who is our Director of Oil Market Publications, and Carl Evans, who's an Analyst of Oil Products at Genscape. So in terms of questions, you'll look at the in the panel on your GoToMeeting panel there is a place to ask questions. You can enter a question in at any time during the webinar, and we will have a question and answer period at the end of the webinar where we'll answer as many of those questions as we can get to within the time limit. So let's go ahead and get started. So our agenda for today, we're going to look at crude by rail, just kind of an overview of what the situation is with crude by rail. Then we're going to look at following the money, look at the price movements that are associated with it. Take some time to talk about Canada and the effect it should have on crude by rail this year, some of the challenges that face crude by rail, and then we'll take a brief look at our PetroRail Report, which is the newsletter that we do that covers the crude by rail markets. So moving right into the overview. So 5 years ago, railroads were moving an insignificant portion of U.S. crude oil production. Today, it's somewhere around 10% of production, depending on your source. So what happened? In a single word, you can say shale. The technological advances that allowed the oil industry to produce crude from shale formations resulted not only in a huge increase in domestic oil production, but also in some very important cases, they shifted the focus of drilling activity away from traditional producing areas. The most obvious example of this, of course, is in the Bakken. Oil production in the Bakken Formation in North Dakota skyrocketed. It went from an average of about 240,000 barrels per day in 2009 to 850,000 barrels a day in 2013. As of November 2013, average daily production in the Bakken had reached roughly 970,000 barrels per day. And while that was great news from a production standpoint, from a transportation standpoint, there was a big problem, and that was the lack of pipeline infrastructure. There were only a few pipelines in place to move the light sweet crude out of the Bakken, and they were just insufficient in terms of capacity. So getting the oil out of the production areas and to refining centers required a different solution. So the oil industry went back to its roots and turned to rail. In 2009, we had something like 12,000 carloads of crude that originated in the United States. By the end of last year, that figure had mushroomed to 400,000 carloads, or roughly 265 million barrels, depending on how you calculate barrels per car. At the same time, total rail loading in the Bakken, as monitored by Genscape, and we monitor about 90% of all loading in the Bakken, also jumped significantly, going from about 10 million barrels in 2012 to roughly 25 million in 2013. So clearly, crude by rail has become a significant factor in transporting crude and crude oil in the United States, and we believe it will become an increasingly significant factor in moving much more Canadian crude oil from producing areas in Canada to markets in the United States, and we'll have more about that later in the presentation. So the expansion of the rail infrastructure for moving crude has grown rapidly, as you can see by these figures from Genscape's internal database of projects. Looking at it from a regional perspective, you can see that far and away the Bakken has the largest amount of existing rail capacity, but it's noteworthy to look at both the existing and planned capacity for Canada, most of which is in the Western Canadian Sedimentary Basin. Canada has roughly 500,000 barrels per day of existing capacity, but there's a whopping 677,000 of planned capacity, which dwarfs any other area's planned construction. On the unloading side of the equation, the U.S. East Coast and the U.S. Gulf Coast are roughly on a par in terms of existing capacity, with each coming in roughly at 900,000 barrels per day. Planned capacity on the receiving terminal front is robust, with most of the activity coming in the Gulf Coast, and importantly on terminals with access to water, either inland waterways or coastal ocean waters. As you can see, there are plant facilities in the Pacific Northwest, East Coast, and West Coast, almost all of which revolve around railing through the terminals that allow the oil to be transported by water to coastal refineries. Okay, so people say, crude by rail is playing a role now, but what makes you think it has any staying power? It won't more pipelines be built, eliminating the need to move oil by rail? And we believe the answer to that is yes and no. More pipelines are being constructed and more on the drawing board, and those pipelines will eliminate some of the need for crude by rail, but we believe rail will continue to play a significant role in moving crude in North America for one simple but important reason, and that's flexibility. If you look at this slide, the rail system in North America reaches into every producing area in the United States and Canada, and also into every potential market area. It gives producers the flexibility to transport their oil to the markets that offer the best possible netback in an environment where price changes constantly and drastically. It also gives refiners the flexibility to buy and transport the specific types of oil they need for their individual crude slate. Pipelines, by definition, start at one place and end at another. Rail, on the other hand, has many origination and termination points, and they're configurable. A case in point, several months ago, Kinder Morgan announced an open season construction of a pipeline from southwest Texas to southern California, but then they had to cancel the project due to a lack of interest. The reason shippers cited for their reluctance to commit to the pipeline was the flexibility offered by rail. I mentioned producers being able to shop for the best price for their oil, and it is just that, price differentials, that are driving the movement of crude by oil. And now I'm going to turn things over to my colleague, Colin Halling, to discuss what we've been seeing in terms of price and crude by rail movement. Colin?
Robert, thank you very much indeed. Good afternoon, everyone. Just as a sort of initial observation to make on this, I want to add in a couple of sort of caveats, really. And I think the first point to make about spotting the kind of trends that we're looking at today is that the physical oil markets have a tendency to change direction relatively gradually rather than rapidly when it comes to the direction of pricing arbitrages. We're putting together a weekly report, so obviously every week we're asking people what are the latest changes in direction, and these changes that we see, one of the responses that we get is they're gradual rather than dramatic. So when the kind of pricing and the other factors that we're looking at here exert the kind of influence that they do on the direction of these arbitrages, we just don't see trading flows doing rapid or 180-degree changes in a particular direction. I mean, for example, the direction of marginal or spot or the next railed crude barrel might be influenced by price variations. Obviously there's an awful lot of longer-term supply contracts that can be signed for a number of months, say, and those will often mean that we will continue to see flows of oil that move into what on paper might not necessarily always appear to be, to market watchers, the most profitable destination at that particular moment in time. I said it's a longer-term directional change than that. And for example, I mean, this is the physical oil market, and people will sometimes have an individual approach to that. And so, for example, some shippers of crude may also choose to adopt a particular strategy of making use of their own tend to be gradual, and they tend to happen at the margin, and they tend to be more discernible over longer periods of time. So the two big main advantages, amongst others, that are often cited by people that we talk to or people that are involved in the crude by rail sector in favor of moving crude by rail rather than by pipeline, they probably boil down to two, really. One is the speed with which you can get your crude to market, but most importantly, really, and Robert's already very much touched on it, is the aspect of flexibility. that you simply don't have with a pipeline. It's maybe an obvious point, but it's still a point worth making for that. And obviously from, say, particularly a refiner's perspective, what this flexibility means is that a number of different supply origins, you can evaluate them, and assuming that the requisite rail infrastructure is in place, and that might not always necessarily be the case to the volumes that are required, you can choose a particular crude from a particular supply point and choose it on the most cost-effective basis. But as I mentioned, this also raises another caveat, I'm afraid, which is often the case that a particular refinery's nameplate crude capacity can really comfortably exceed the capacity of the existing or the permitted crude by rail unloading infrastructure that's attached to that refinery. Depending on things like pricing or potential alternative supply points, in many cases railed-in crude is cheaper than the alternatives. In other words, what this means on the ground is that some refiners should be really bringing in as much railed-in crude as the available infrastructure permits. And in most cases with that, most small or short-term changes in pricing might actually have rather little effect in their doing so. They simply want to move as much rail crude as their infrastructure allows them to within certain fairly broad price parameters. But having said that, as the developments that we also keep an eye on for rail infrastructure continue to let the market move towards what economists call a more perfect rail crude market, we do certainly see pricing and demand and other factors having an influence over the rail unloading volumes at the terminals that Genscape monitors, and especially we see this, as I said, over a longer period of time. This much talked about advantage of flexibility that rail offers to the market does also enable the marginal barrel to find its way to a variety of destinations as the profitability and demand in each main consuming region rises and declines. This first slide here, Genscape monitors one of the two rail unloading terminals that are located in Albany in upstate New York, and from there crude is generally moved onward by barge or ship to supply refineries that are located on the east coast of North America. Genscape started monitoring the unloading volumes at this terminal in Albany using visual monitoring technology in August 2013. And as this graph shows, at that particular time the spread between Brent and WTI is relatively narrow. For East Coast refiners, the comparative cheapness of physical North American crudes, with price of WTI obviously increases versus some of the more traditional supply sources for East Coast refiners such as West Africa or Europe, for example, which tend to price related to Brent. As you can see, the correlation isn't perfect. This is the physical oil market, and with physical oil markets there are a lot of other physical factors in play to make correlations exactly perfect between necessarily pricing and monitored unloading. But I think it does show here that the volumes have increased that we've monitored in line with the Brent WTI spread, and often we can see at places there that this has happened with a bit of a time lag, which of course is to be expected. On the next slide, the first crude by rail terminals for unloading that Genscape really started monitoring in volume are located in St. James in Louisiana, where we monitor two facilities, and we've done so since the middle of 2011. As these two slides show, one of the ways of obviously assessing the relative strength of demand in the US Gulf PADD 3 physical crude market is by looking for the premium for Louisiana light sweet crude over WTI and also the outright price of LLS. The slide on the right shows the premium to WTI, and frankly it doesn't show particularly close correlation. But if we look at the one on the left, the outright price of LLS crude, where we've plotted that versus the weekly total unloadings at the two St. James terminals that we monitor versus the outright price of LLS crude, there is a fairly an improved, certainly visible correlation. So to run the risk of stating the obvious, the market sends more crude to the US Gulf to an extent by rail when the outright price signifies that demand is better there. Another rail unloading terminal that we monitor in Genscape and that was covered by the PetroRail report is located in Stoud in Oklahoma, and the terminal there is connected to the main Cushing storage hub by the 90,000 barrels per day capacity Hawthorne pipeline, which Genscape also monitors. Now, as I'm sure everyone's aware, the main method of oil transportation used to move crude into and out of Cushing is not rail, really, primarily, but it's mainly by pipeline. But when we looked at this data, we have the monitored unloading levels of crude at Stoud correlate to an extent with the Cushing stock levels that are also monitored by Genscape. Again, not always, but I was relatively surprised by the correlation that we see here at times. And that another point to make about talking about monitoring Stoud is that there were no monitored unloadings there by rail for almost exactly a year until August 2013, when Genscape monitored both the increased level of crude being pumped on the Hawthorne pipeline, and very shortly after that we monitored a unit train of Bakken crude then arriving at Stoud to discharge. And the chart on the right is something of a sneak preview, really, as we don't yet publish this information regularly anywhere, but we are highly confident of being able to do so in the very, very near future. And as well as the visual monitoring, that is the way that we have hitherto monitored activity at rail terminals, Genscape is also moving towards making use of a new technology, for us anyway, of being able to monitor rail movements by the use of radio signals. And this way of monitoring can either be used to supplement visual monitoring data, which you have as well, or, as in this case, it's enabling us to get a handle on volumes at unloading points where it can prove difficult for Genscape's engineers sometimes to get a good, reliable view of a particular facility that we know that we want to start collecting information for so that we can publish it. In the case of Anacortes here, railed-in crude competes with Alaska North Slope crude on price, and we're seeing here the number of railed movements from Epping in North Dakota to Anacortes increasing in line with the outright price of ANS with which this railed Bakken is competing. As you can see by the date range on this particular data, it's very early days for this, but we are hoping to be able to add Epping to Anacortes movements to our PetroRail report very soon, as part of a sort of an overall aim to be able to monitor activity both in the form of loadings and loadings at least one particular point in each of the main regions. That's kind of our aim, is to get there with that, and then we can add to that, of course, and we certainly plan to add to that as we go on. And with that, I'd like to hand you over back to Robert. Thank you.
Thank you, Colin. So this slide is showing a picture of the new Connectus transloading terminal in Bruderheim, Alberta, just outside of Edmonton. It's called the North American Terminal Operation, and it started loading unit trains back in November 2013, and it's really the first unit train facility out of that region. As of this month, the company expected to be loading 14 unit trains, or about 30,000 barrels per day. And Connectus is on track with its expansion plans, and an additional tie-in to the Cold Lake pipeline expects to reach a rate of 10 to 11 unit trains per week by the fourth quarter of this year. We will be adding Bruderheim to our monitoring very shortly. We already have cameras in place, and we're looking what's going on in Bruderheim, and right now we're just making sure that we're getting good data transmissions and incorporating that data into our IT system. But everything's looking good, and we should be adding Bruderheim loading to our PetroRail report in the very near future. As of now, the terminal is still moving dilbit, but it said it plans to install a diluent recovery unit at Bruderheim, which would allow it to obviously remove the diluent from the dilbit it gets through the pipeline and ship it in heated cars, thereby increasing the volume of actual crude that's moving by rail. The dilbit, as many of you know, normally accounts for about 30% of volume. And so there are 20-plus loading facilities in operation or planned in Western Canada, another 15 loading terminals in the Canadian Bakken region. Next one, this is a table from our good friends over at RBN Energy. It's a little bit hard to read, but effectively what it shows is the existing and proposed capacity for crude movements of heavy oil from the Western Canadian Sedimentary Basin. This is part of their new drill down report, which Rusty Brazil at RBN Energy asked me to tell you is available at a low, low price. It also shows new facilities under construction. These 23 terminals account for existing capacity of about 250,000 barrels per day total, and when and if they're built, all of that capacity will be about 740,000 barrels per day. There's a reason for all of this capacity. Oil sands production at roughly 1.7 million barrels per day accounts for more than a half of total Canadian oil production, and is expected to grow at about 6% per year through 2030, according to some estimates. I believe those are the official estimates from the Canadian Association of Petroleum Producers. That oil is going to have to get to markets in the United States somehow, and at least for the foreseeable future, that means rail will play a significant role. There was a study last year by Raymond James that estimated that crude carloads from Canada could top 70,000 this year. And as an aside, operators are increasingly talking about enhancing the economics of crude by rail by backhauling diluent to Canada, which can effectively cut crude transportation costs by something like $2 a barrel, which means a better net back for Canadian producers. Everyone concentrates on the heavy oil out of Canada, but it's also important to remember that a big portion of the Bakken Formation also extends into Canada, and that Canadian Bakken production is situated along the rail systems of both the Canadian National and Canadian Pacific rail lines in the region. That's another 14 or 15 loading facilities with a capacity of more than 100,000 barrels per day. As I said, the oil sands production, and at the same time oil sands production in Canada is going up, the diluent that's required to move it by pipeline, and a lot of times by rail, that production in Canada is going down. And to get a little more into the details on the production and the diluent situation, I'll turn it over now to Carl Evans to talk about that.
Yeah, thank you, Robert. So looking a little further into those producing areas in Canada, we have this this next graph that you can take a look at. As you can see here, for 2014, we expect about just right around 300,000 barrels per day coming out of Alberta. That's obviously the largest area of growth. Most of the growth in general for Canada will be coming from the Western Canadian Sedimentary Basin. That also includes Saskatchewan as well, and Manitoba, and some small production in British Columbia. As you can see, production largely in Ontario, Northwest Territories, and Newfoundland, and those are mostly the offshore production platforms, are all declining. Just to give another kind of number for 2015, we expect growth also to continue out of Alberta at about 284,000 barrels per day. So that's a lot of growth coming out of Alberta in the next 2 years. If we look to the next slide here, so as we can see here, we've split out basically total Canadian production versus pipeline takeaway capacity. As we can see here, we have crude bitumen. That's your heavier crude oil at the bottom. Then you have your synthetic crude oils, which is the green. That's coming out of the 5 upgraders in Alberta. And then in the purple, you have total conventional, unconventional supply, and that's coming out of the 4 Western Canadian provinces. And then at the top, we have a diluent and blend estimate, and that's based on what we know will be what has flown on the pipelines, the major trunk lines, in terms of heavier oil, so your crude bitumen. Also, if you look there, we have a major trunk line flow so that's the major pipeline flow line, and then also pipeline capacity, and that's total effective capacity based on our estimates and what we've seen from a lot of the pipeline companies. So just to kind of talk a few numbers here, approximately 65% of year-over-year growth is coming from the Western Canadian oil sands, and that's year-over-year growth. Also, if we look, Alberta is increasing 220,000 barrels per day in 2014, an additional 238,000 barrels per day. That's just in situ oil sands, so that's the largest area of growth, and that's going to be all of your crude bitumen supply there. So as you can see here, really these two slides have just been put here just to kind of show what we expect the pipelines can do, and then likewise, if you look even into 2014, 2015, you see supply is overtaking current capacity, so rail is going to have to be in place there to take away. And I guess from here on out, we can talk a little bit more about the rail side of things and turn it back over to Robert.
Thank you, Carl. I'm actually going to let Colin talk right now about some of the challenges that we see in the crude by rail.
Thanks, guys. Yeah, in the best Hollywood tradition of casting a Brit as the villain of the piece, I'm going to just talk a little bit about some of the challenges that may face the crude by rail sector going forward. None of these, I think we've already talked about. None of these are, going to mean that we're going to turn the clock back 5 or 10 years back to crude. I think crude by rail is far too well established by now. But just to talk about maybe some of the headwinds that the whole sector may encounter as we go forward. As we've already touched on a bit, increased pipeline capacity sometimes does compete with railed-in crude some areas, and that obviously when pipelines are built, they move a barrel of oil cheaper than trains do. Again, one of the advantages of this flexibility, again, that we've talked about, it's become less, I think, the perception in the industry of either an either-or or a zero-sum game between pipe and rail. I don't think people tend to talk about that quite so much anymore. I think that view seems maybe slightly out of date by now. I think most people that we talk to anyway see the two modes of transportation as very complementary to each other, but still in some instances pipeline does compete with rail, and that can happen. This is obviously something of an elephant in the room. The new regulations about retrofitting existing tank cars. I'm going to deploy a bit of British understatement here and say that in some quarters I think the industry, this particular sector, might be said to have something of an image problem, and that most people that we talk to seem to be expecting now some sort of regulation inevitable in the wake of these accidents that have taken place in recent months. We've also increasingly seen recently number of companies announcing that they're solely going to use these more modern post-2011 specification of rail cars voluntarily. I mean, does it seem likely that very strict regulations are going to kill off this growth in the industry as soon as it's taken off in the way that it has? We suggest that's probably rather unlikely. It's funny, these things have a tendency to repeat themselves, and I've covered the tanker shipping market in the past, and it's extraordinary some of the similarities that we see there. You see a high-profile accident or set of accidents. You see a number of companies saying before any regulation that they're going to adopt a more modern approach to the kind of equipment that they use for moving the oil, and then following that we see a sort of regulation in place that takes maybe some of the costs get absorbed, and the whole industry pretty much continues in the same sort of way as it was before, but with slightly more modern equipment being deployed. The oil in this instance always finds a way because it's simply far too profitable to move it for it not to. The permitting issues for proposed facilities on the US West Coast, these can be hard to come by. There are a lot of restrictions in place there. It's a lot harder to build new rail facilities there than in other parts of North America. especially. But however, as we're seeing, rail crude is often cheaper than the ocean-supplied alternative. Differentials can also affect volumes at the margin, and Brent WTI we've talked about as two independently traded benchmarks. We can see that fluctuations in that can impact on the profitability of crude by rail, and we've, pardon the fun, seen that made manifest in things like the rail car leasing rates that we assess, as well as in the volumes that are shipped. So yes, just to talk on there a little bit about some of the headwinds that that the industry may face, none of which I think are likely to deal a particularly killer blow to the industry. I think the industry is far too well established by now for that to be the case, and I think that we wouldn't necessarily be seeing the investment in infrastructure ongoing that we've already talked about were that not the case. And with that, I'll hand you back to Robert.
Thank you, Colin. I don't know about anybody else, but I had a little bit of a technical difficulty there and lost my telephone, but I'm back. So what we wanted to do now was to move into sort of a quick overview of our new PetroRail Report newsletter, which is our premier crude by rail product. Our intent with this product was to go beyond just merely providing fundamentals data from our monitoring equipment and to put that data in perspective in terms of what it means in today's North American crude oil market. As you can see from this slide, we highlight some of the fundamentals data that we do get from our proprietary monitoring of loading and unloading facilities, including Albany, St. James, and the Bakken overall. We also report each week on spot leasing rates, as you can see. In addition, we calculate producer netbacks to take into account all the transport costs of gathering, loading, freight costs, lease rates, unloading, and when applicable, barge fees. The only element we don't include at this time are energy surcharges levied by the railroad. In addition to the rail netbacks, which we do for light oil and for heavy oil, we also calculate the differentials, which are the difference between the netback and what the producer could get by selling his or her oil in the producing areas. We also include pipeline netbacks, which take into account the full cost of moving crude through pipelines rather than just the tariffs associated with the pipeline. That's especially true for the heavy oil netbacks, which you can see in this page on the right. We recently revamped our netback coverage so that now we're looking at, for the heavy oil, and we're looking at netbacks against various things, including Maya and number 6 fuel oil in the coast, which is actually, I think, a more appropriate sort of netback look for the bitumen because of the amount of resid that's in a barrel of bitumen. So, and then moving on to the next page, this again, we show not only the netbacks with the undiluted bitumen, but we're also looking at netbacks for rail bit, taking into account diluent content in rail bit of about 20%. And then we look at the differential by transport mode as well, which is supposed to give our readers just sort of a snapshot of if I were moving this by rail from Hardisty to the U.S. Gulf Coast, for example. Here's the difference between what I would get by rail versus what I would get by committed pipe or uncommitted pipe. And we define those as pipes on which you have purchased long-term capacity or on which you're purchasing capacity on a spot basis. We also include a map that shows freight costs for certain routes, and we change this map as applicable. We get these routes in a variety of ways, including sort of what we think of as traditional price reporting, in that we talk to people every week about what rates they're paying from point A to point B. In addition to this, we also include a lot of fundamentals data, and I'll let Colin talk a little bit about that.
Thanks, Robert. Yeah, what we have here is the data of our monitoring at the Albany terminal that we talked about before. So this is how much has been unloaded there each day. The other one is the chart that shows weekly Albany unloadings plotted versus the Brent WTI spread. The other one, the next one is Stoud, the amount of rail cars that we've monitored unloading at Stoud during the course of the past week, and in tandem with that is the monitored flow on the Hawthorne pipeline. Underneath that, these are plotting our leasing rate assessments for rail cars. We assess these in a traditional market assessment, talk to people, find out where they think is a reasonable level for this traditional market intelligence gathering way, and so these are proprietary Genscape price assessments for both the 6 to 12 month leasing terms on the rail cars, so including the 30,000 ton unheated and the 29,000 ton coiled and insulated market. The next ones are again simply a graphical representation of what we monitor, which is total volumes per day for the week just gone at the rail loading terminals and at unloading terminals. And then those two there are, the last two are not Genscape data but AAR data showing the amount of crude that has been transported by US and by Canadian railroads during the most recent week for which they have data available. And with that, I'll hand you back to Robert. Thank you.
Thank you. That's our presentation, and now we would like to open it up to questions. And I think Colin is going to handle sort of reading out of the questions, and we'll, whichever one of us is appropriate, we'll be happy to answer the questions.
Yes, thank you. One question that we've received quite a few times is, will this information and will these slides be available after this presentation, so that let's start off with an easy one and say yes, they are. And we have a couple of minutes for questions, but just to say that if there are any questions that we don't get around to answering today, then our contact details are available, and please feel free to contact us at any time, and we'll try and deal with them outside of this particular forum. Let me see, what questions do we have? Do we monitor rail car purchase prices is one of them. We don't at the moment, no. We monitor leasing. Again, this report is a report to which we very much consider to add information to as we go forward. So if that's something for which we can easily get information and that people think would be of interest, then that's absolutely something for us to bear in mind. Do we have any plans to monitor any light oil rail terminals in Canada is one of the questions. Robert, at the moment, I'm not sure that we have immediate plans in place, but
yeah, no, in the short term, what we're looking at in terms of our monitoring is we're really concentrating more on the unloading terminals that we think are increasingly important, places like Yorktown, Virginia, Anacortes in Washington, the other facility in Albany, some of the Gulf Coast stuff, Natchez, Mobile, to catch the Canadian heavy crude on the receiving end. But in the moderate to longer term, we absolutely will be looking at monitoring all of the Canadian rail facilities, including the light oil facilities.
Do we monitor any LPG logistics and railcar lease rates? The short answer is no. But again, the long-term answer is that, again, if we have the ability to do that and there is a perception, then obviously we will.
Yeah, and I would add to that we don't at the present time, although some of what we're looking at in Texas and the Eagle Ford region with our facilities that do transport NGLs as well as crude, and we also will be looking at the Marcellus Utica to see what what we might be able to do in that area as well. It is an area that we're looking at. It's just not the highest priority for us at the moment.
Okay. When you are calculating a netback in the PetroRail report, what is included in those transportation costs? Is it an all-in number, including tank car leases, transloading, etc.?
It is an all-in number, including lease rates, gathering, loading, unloading. Depending on the terminal, it may include barge fees as well. So yes, it is an all-in transportation cost.
What trends have you seen in freight costs over the past 6 to 12 months? Have they been going up or down? They don't tend to change too much. It's the one trend that strikes me, particularly, as I said, having previously covered the tanker shipping market, where a lot of cargoes are negotiated on a case-by-case basis. One thing that is relatively striking about the rail freight costs is we look at them every week. We ask people about them every week. But one of the most common retorts I hear from the contacts that I ask about this, who have a great deal of patience in dealing with my questions, is, well, they really haven't changed too much. So they tend to not change too much. One thing that we, however, do see quite a lot more fluctuation in is on the railcar leasing rates, and that those are perhaps more responsive to wider market economics than the actual underlying freight costs for this. I think what would be interesting purely from a would be to see crude by rail economics change significantly, and then see what impact we'd have on the freight costs. But for now, they don't tend to vary a huge amount. Is the boring answer. So they don't. So there's not much of a discernible trend there in terms of the underlying freight costs, I would say. One question we have here, how do you expect the increase in rail loading capacity in Western Canada to affect Canadian crude prices? Carl, is that maybe something that you wanted to chip in on?
Yeah, so mind you, we don't currently release any sort of price forecast, so take this with a grain of salt, but kind of my expectations around that would be that as you tend to loosen these bottlenecks that are, that are in the near-term horizon, you could see some upward pressure on WCS relative to WTI. But you got to keep in mind also that that's dependent on permits for a lot of these major lines, and if those get delayed, and also the construction of these new rail terminals that we do have listed, because sometimes they may announce them, but it may not go up for a year or 2 years later, and that obviously makes a huge difference. I have read some comments from some heavy oil producers saying that they've expected WCS to narrow from a range about $20 to $25 a barrel below WTI to as close to $10 to $15 a barrel. So I have heard that, but I have also heard that 2014 could be a volatile year for that, and I suspect that that's due to all these new rail loading terminals and how they actualize in terms of going up and shipping crude. So I hope that kind of answers the question.
Thank you. A set of questions coming in. By speed to market, do you mean not having to wait until the pipelines are ready, or that rail physically moves a barrel faster than a pipeline to a refinery, or both?
Yeah. Go ahead.
My suggestion would be both. It does move it more quickly, but also, as we've seen, permissioning for pipelines obviously can be a very protracted affair, and it needn't necessarily be quite so protracted for the rail side of things.
Let me jump in there too, Colin. So yeah, it is both, but I think the real essential element there is that how much quicker you can get it there by rail than by pipeline. Something like 40 days to get by pipeline to the Gulf Coast from Canada, versus like 8 to 10 if you're using a unit train transportation. And the important thing about that is, if you can do turns on those trains and you can do 2 or 3 trips a month, then you've very much lowered your per barrel cost for delivery. So I think that the speed with which you can get it there by unit train, by rail, it is an important factor when you look at that versus pipeline transportation.
Presuming that U.S. West Coast facilities can get permits, which ones do you feel are best positioned to be economically justified or win? I don't know if we really necessarily feel totally comfortable sticking our neck out about individual companies' facilities in this particular context, but I think the point that I would make is that what seems to be very much increasing, in terms of the facilities that are being planned and developed in other parts of the U.S. Seems to be rail terminals that connect with being able to load then onto barges in order to move further. I mean, that's a recurring factor across all the terminals. I don't know if the other guys have any views on this.
Yeah, I'd add a little something to that as well. Because I think the last point that Colin made is a really important point. One of the things we're seeing with crude by rail is that, sort of the holy grail of that is to move the crude by rail to a waterborne terminal and then move the crude by water to where you're getting the best net back. You're seeing a lot of this out of the Eagle Ford now, where crude is being moved to the port of Corpus Christi and then being moved by barge or tanker along the Gulf over to over to St. James or over to Luke, but then also up the East Coast to refineries like the Bayway refinery, and that's all Jones Act vessels. And if you can move it in a non-Jones Act vessel and move it up to Canada, your transportation costs are even less and your netback is even greater. So we're seeing that increasingly, and obviously that's what companies want to do off the West Coast. They want to rail the crude to terminals on the West Coast and then move it by tanker or barge down the West Coast to the California refineries. I think increasingly that's a very economic play.
And I might add something too, just on the Canadian side of things. Once again, without naming any sort of areas or companies who are operating those terminals, look to where, especially oil sands in situ production is scheduled to ramp up in the next year or is ramping up currently, because you'll see, whole new flows of crude oil coming onto the market, and they're going to relatively hit the same areas. So look to those key areas, Edmonton, Hardisty, who can get, rail car loading facilities set up there the quickest might get that supply quicker.
One question we have, where do you get rail costs from? Do you simply take a quote from the railroad's website, or do you talk with crude sellers and buyers on what they're actually being charged effectively per barrel by the railroads? Yes, very good question. I mean, we get the rates from talking to as many different people as we can who are active in the marketplace, whether it be on the railroad side, whether it be from the refiner side or marketer side, shipper side. We essentially look to tie that together, as I said, using information gathered by market intelligence. So a bit of a difference to what maybe Genscape is known for on the monitoring side of things, but that is another way that we do things there. It is, I would think it's fair to say, a sometimes fairly opaque market. We often hear that the amounts that get paid can vary enormously from company to company, so it is an area in which we would hope that we are able to add some degree of transparency. And when people ask us who we're talking to, we say, well, we want to talk to as many people who will be able to give us information on this, and that can prove fairly challenging with that particular information. But I think we do a decent job in getting around to people that we talk to. I'm seeing. Why do you not include the rail fuel surcharge? I believe we do in the purpose of our netbacks, but Robert?
Yeah, so we're working on that right now, actually, in terms of the fuel surcharge, because I think we should include that in the netback calculations, but we have not had access to the fuel surcharge. In order to do that, we're working on a solution to that now, and I think we will have that as part of the netback calculation in the very near future.
Is Albany unloadings for the one monitored terminal or for the total? It's for the one monitored terminal. There is another terminal there which we do not monitor at the moment, and it is for the one that is owned and operated by Global rather than Buckeye. I think we're coming rather to the end of our time now. Robert, did you want to wrap things up at all?
Sure. So we wanted to go ahead and answer as many questions as possible. The ones that we haven't been able to get to here during the webinar, we will be happy to send answers out to those questions. I think, as you can see on the last slide that we put forth, we put our contact information on there. Please feel free to contact any of us with any additional questions or comments. We really always like talking to people in the market about what's going on and what they see. That kind of feedback is invaluable for us, and I think as with any other sort of market-oriented operation or publication, having that conversation with people in the marketplace is essential, and we really look forward to that. So thank you all for your time. I appreciate it,